Good morning. This is John Kogan. I'm the CEO of Performative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to today's webinar entitled PwC Presents VC Investing 2013 Review and 2014 Predictions. 2013 was an exciting year for venture capital, with increased investing activity and headline-grabbing exits. Today, we are fortunate to have with us two senior leaders of PwC's Emerging Company Services Group, who will provide an overview of recent venture capital investment trends and will help us by interpreting findings from the PwC National Venture Capital Association MoneyTree report, which is based on data from Thomson Reuters. I would like to start by thanking PwC, whose commitment to thought leadership in this realm helps us make this webinar possible and delivered at no cost to our participants. A quick note on today's agenda. First, we will hear a presentation from our featured speakers, Kathleen Borey and Claire Hayes. Then we will move to our interactive Q&A session where we will spend the remainder of our hour. We would ask that you hold all questions. Well, actually, you can ask questions at any point in time. However, we will hold questions until the Q&A portion of the event. However, if you have any clarifying questions, in other words, you didn't hear something or something isn't working right on your end, we do want to hear about those. Ask those anytime, and we will handle those in the background as the presentation is running. We welcome you to this performative event. We do have a few notes on this event, which we would like to review before we get running here. Number one, links to today's presentation and a recording of this webinar will be sent out to all attendees via email within 24 hours. So you'll get an email that will have a link directly to our site, and you can download the presentation for free, of course. The presentation is actually already online if you'd like to download it and follow along. It's right at that address right there, performative.com/resources, and it's already up and available for you. Today's event is a CPE event. For those who would like CPE credit, you will need to answer all 3 polling questions during the event. And hopefully you have pre-registered for CPE credit. If you have any questions at all, please send an email to cpe@performative.com. Now, although you will not need to know any mathematics for the polling questions, they will be asking about the content that's being presented, so please do pay attention, and then you'll see those polling questions come throughout the event. Next, we would like this to be an interactive presentation, so please do feel free to ask questions at any point, and we will do our best to get to your questions during the Q&A portion of the event, which does come at the tail end. Finally, at the very end of the event, after I thank everyone and essentially release you and end the event, there will be a short survey that will pop up in front of you. Both we and the speakers from PwC today would greatly value your feedback. It takes no more than 1 minute to answer these few quick multiple-choice questions. We would greatly appreciate you giving us that time so that we can make sure we're presenting the best information possible and that we are always doing better the next time. And next up, a quick welcome to Performative. This may be a first Performative event for some folks, and as such, we want to give you a little background. Performative is the largest online resource for corporate finance and accounting professionals. In 2013, over 1 million unique visitors joined us for senior-level peer insights. Fast, which is to say very fast response if you have questions. Great subject matter expert advice also provided by folks in the community. So we don't provide that, the community, you and your peers provide that. And valuable features and resources such as events like the one you're attending today. All of it's completely noise-free. There's no advertising on the site, and we don't allow any selling or self-promotion. So it's just a wonderful place to meet your peers online and discuss what matters at work. Please feel free to check it out at performative.com. We have some learning objectives for this event. After attending this event, you will hopefully be able to understand some of the key trends in venture capital from 2013 and also have a view on 2014 given by our experts today. Also understand why a majority of the industry sectors saw growth in venture capital investment in 2013, which is great news for VC-backed companies, and also discover investment trends by stage of company development and insights into key factors fueling these trends. So with that said, I would like to stop talking myself here and go ahead and introduce today's speakers so that we can let them take us forward through all of the information today. We have joining us today Kathleen Borey, who's a director in the Emerging Company Services Group, or ECS, at PricewaterhouseCoopers. Before joining PwC, Kathleen had 15 years of experience in marketing and business development roles at companies focused on providing finance and accounting solutions to emerging growth companies in the Bay Area and Southern California. Most recently, she was Director of Business Development at Accretive Solutions, a national consulting firm. Prior to that, she held leadership positions at Capital Advisors Group, an investment management firm, and at Silicon Valley Bank. Kathleen has a bachelor's and master's in finance from Tufts University. Also joining us today is Claire Hayes, Managing Director at PricewaterhouseCoopers. Claire is based in PwC's Silicon Valley office and has over 15 years of experience with PricewaterhouseCoopers. She has extensive SEC experience, assists public and private companies in addressing complex issues, including equity transaction accounting, revenue recognition, preparing for IPOs, and Sarbanes-Oxley 404 implementation, amongst others. Claire has participated in several IPOs, carve-outs, M&A transactions, and 10A investigations. Claire is a member of the AICPA and Cal Society of CPAs. She's also a chartered accountant. Claire is an active community leader participating on nonprofit boards, including Child Advocates of Silicon Valley, United Way Silicon Valley, and the SV Forum. So, Kathleen and Claire, thanks so much for joining us today, and please do take it away.
Thank you, John. This is Claire speaking here. So before I get into the report here, I just wanted to give some background on the report. So this is a report that's based on data from Thomson Reuters, and it's produced in conjunction with the NVCA, the National Venture Capital Association. The core measure here is equity investments in venture-backed companies in the United States, and we focus on companies that have received at least one round of financing involving a professional VC firm or equivalent. And then you'll see here, what it captures in terms of tranches, foreign VCs, and qualified private placements, and excludes debt, bridge loans, recaps, etc. And MoneyTree is in the 19th year of production, and the results are also online at pwcmoneytree.com and also at the NVCA website. So moving forward into investment trends. So first of all, I'd like to take you through the quarterly trends for 2008 through 2013. This slide shows dollars in billions of dollars. And you'll see here from the graph the investments for Q4 2013 on the far right-hand side. There was $8.4 billion of investment in Q4 2013. And that compares to $7.9 billion in Q3 of 2013, which represents, approximately a $0.5 billion increase quarter over quarter, which is approximately 6% increase. Now, Q4 2013 at $8.4 billion compares to Q4 2012 at $6.9 billion. So you can see that the investments here are ticking along quite nicely, and Q4 was quite a good quarter. If you move further on down the slide, we're looking here at number of deals. And in 2013, on the far right-hand side of this slide, you can see that in Q4 there was 1,077 deals, and that represented an average deal size of $7.8 million. That compares to Q3 2013 of 1,032, which was an average deal size of $7.7 million. And then if I compare that to Q4 2012 at approximately 1,000 deals, that's $7.1 million. And you can see if you look going back along on the left-hand side there, the trend going from anywhere between 700 to 1,000 deals. So we're in quite a good spot here at Q4 2013. So this next slide here looks at the annual trend. And this, again, is billions of dollars. And so for 2013, the total dollars invested was $29.4 billion. And that compares to 2012 of $27.3 billion. and that represents a $2.1 billion increase, or a 7.7% increase. So quite a nice increase. And again, I think it's quite interesting to look across this chart here and see, where 2013 compares to the other years. You can see it's holding up quite nicely. And then obviously the one that stands out is back in 2000, where it was like an extraordinary $105.1 billion, which is completely crazy in hindsight. And then if you move on further down to number of deals, you can see in 2013, the number of deals in 2013 is 3,995, giving you an average of $7.4 million per deal size. And that compares to 2012 at 3,858. And then if you look along, again, this chart here, you'll see, the average is, there's an average of like 3,000, plus type of a number of deals per year, except, of course, in 2000, where you were at an extraordinary, 8,000 plus deals. Okay, so this slide is showing is quarterly percent of total investments and showing the top 5 U.S. regions. And you can see, Silicon Valley is by far and away the top there. And then you've got New York, New England, Northwest, and LA and Orange County. And so, Silicon Valley did receive the highest level of funding for all regions in the fourth quarter of 2013. Although there was a decrease of 12% in dollars and a 4% in deals from the prior quarter, with $3.2 billion going into 306 deals. And then if you look at New York Metro, received the second highest level of funding and deals, compared with $1.2 billion going into 123 rounds, raising 74% in dollars and 5% in deals from last quarter. And New England investments came in third and experienced an increase, rising by 7% in terms of dollars, but dropping 5% in deals, with $917 million going into 106 companies. So of the 10 of the 18 MoneyTree regions, they experienced an increase in dollars invested in the fourth quarter. And not showing here, but other information you'll see on the MoneyTree website is that areas like Arkansas and a whole host of areas in that kind of region, geographic region, increased by 508%. The Northwest increased by 227%, and New York, as I mentioned, increased by 74%, and the Southeast increased by 69%. So 15 of the 18 regions experienced an increase in the number of deals as well.
What's interesting, sorry, this is Kathleen, what's interesting about this last quarter, well, about this slide in general in this last quarter is I think this is the first time that New England was not the number 2 spot, that New York Metro came in. And a lot of these secondary areas tend to rise and fall in the rankings because they tend to be clustered around a specific industry sector. So software internet really drives what's going on in New York Metro, and they tend to be concentrated in that, whereas New England is more life science oriented. So it's just kind of interesting to see how those secondary areas have moved around based on the fortunes of the various industries.
True. Yeah, a good point.
Hey, Claire, quick question from someone in the audience. I thought I'd toss it in here real quick. Does the investment in Silicon Valley include the entire Bay Area?
Yes, it does, yeah.
That's great. Thank you.
Yep. So then I just wanted to also comment on, investments by region overall for the year, give you some commentary on that. So, 6 of the top 10 regions to attract venture capital funding in 2013 recorded an increase in funding over the prior year. So, 2013 was a good year. The DC Metro region, which is not shown here, reported the greatest jump in 2013 investment levels, with a 104% increase in funding, followed by the Southeast with a 62% increase. Silicon Valley, again, was for the year, the top region for the year, attracting 41% of total U.S. venture capital dollars and 31% of total U.S. deals. New England was a distant second, 11% of total U.S. dollars and 10% of total deals. And taken together, the top 3 regions, Silicon Valley, New England, and New York Metro, accounted for 63% of venture capital funding and 53% of deals reported in 2013. So, I think quite stellar metrics overall. So now going into investments by industry and just looking at the various industries here. And before I launch into this particular slide, just know that there are particular definitions regarding software, biotech, media and entertainment, IT services, and industrial energy. And so just for your information, the media and entertainment category in terms of the MoneyTree analysis covers creators of products and providers of services, and also covers online providers of consumer content. They're included in that category. Included in the IT category are providers of computer and internet-related services to businesses and consumers. So there's a whole host of services included in there. And then industrial and energy includes producers and suppliers of energy, chemicals, and materials, and also includes environmental, agricultural, and utility-related products and services. So just so people are clear on what the definitions are there. So if I just take a look at software here, you can see that software maintained its status as the single largest investment sector for the year, with dollars rising 27% over 2012 to $11 billion. And that $11 billion was invested in 1,523 deals, which was a 10% rise in volume over the prior year. And this represented the highest level of investment and largest number of deals that the software sector has seen since the year 2000. So, very significant. In terms of the quarter, software remained the #1 sector in Q4 for both dollars invested and number of deals, with $2.9 billion going into 397 companies, nearly 3 times the number of deals in the second highest volume sector, media and entertainment. So quite significant. And then I just wanted to scan over to this next slide here, which talks about Internet-specific investments here by the quarter. And so Internet-specific companies experienced a 7% increase in dollars and a 6% increase in deals for the full year 2013, with $7.1 billion going into 1,059 rounds compared to 2012, when $6.7 billion went into 995 deals. So this investment marked the highest level of Internet investment since 2001. So again, a very significant year for Internet-specific deals. And for the fourth quarter, $2.4 billion went into 273 Internet-specific deals. And I just wanted to give some commentary as well. One of our global leaders here at PwC, the global software leader and technology partner at PwC, had a comment there recently, basically saying, advances in technology continue to revolutionize how companies engage their customers on nearly every level, and has changed the landscape of virtually every industry, as we all know. And consumers can see how innovation is changing their lives in the Internet and software spaces, and are eager to embrace technology at a faster and faster rate. And combined with the high ROI being driven by the success of recent IPOs and an active acquisition market, it is no surprise that more venture capital dollars are flowing into early-stage software and Internet companies. In fact, investments in software companies accounted for more than 1/3 of all VC investing in 2013. So, it was a very big year, I think, for Internet and software companies. And moving on here to the next slide, which we're talking about life science. And on this slide, it's broken down between biotech and medical devices and then combined into life sciences. So, for the overall year, biotech investment dollars rose 8%, while volume decreased 2% in 2013 to $4.5 billion going into 470 deals, placing it as the second largest investment sector for the year in terms of deals and dollars invested. The medical device industry fell 17% in dollars and 4% in deals in 2013, finishing the year with $2.1 billion going into 308 deals. Now, in the fourth quarter of 2013, $1.3 billion went into 134 biotech companies, while $460 million went into 94 medical device deals. And then the life science sector, which is biotech and med device combined, accounted for 23% of all venture capital dollars invested in 2013, compared to 25% in 2012. So, it was a strong year for biotech, and I think that is signified as well by the amount of biotech IPOs that are out there, and the biotech pipeline that is still coming along, and the market's been quite hot, so, and keeping us all very busy here at PwC.
So Claire's done a great job of giving us an overview of general investing trends, and then starting to take a deeper dive looking at some of the trends from a geographic point of view and then from an industry point of view. And I'm going to pick up on this deeper dive and go a little further and take a look at trends from the order in which investing has been done. And so this slide here has a lot of stuff on it, and I'll just kind of walk through it. The circle chart on the left is looking at the amount of money that was invested by first sequence, meaning the first money into a company, versus the follow-on, so rounds that would follow afterwards. So not necessarily by stage of development, although you could say that one is a proxy for the other. And then the little chart on the right-hand side is quantifying the activity, comparing the change from 2012 in number of deals from a first sequence point of view and follow-up. So let's take a look at the circle graph first, and what you can see here is intuitively what you would think, which is that the bulk of the money goes into follow-on rounds rather than first rounds. And this makes sense because as companies grow and mature, investors will put more money in anticipation of the company going towards some sort of exit, whether it's acquired or going public. And that's just been a trend that's been around for time immemorial. When you look at the chart on the right-hand side, which looks at the level of activity, what you can see here is that the increase in overall funding was also reflected both at on a first sequence basis and on a follow-on basis. So there was more activity both at the front end and throughout the pipeline. But what you can also see here is that there was more of an acceleration in activity in the first sequence deals that were done rather than the follow-on. So more dollars going to later stage deals, lots of activity across the spectrum, but an acceleration of activity at the front end. And we can now go to the next slide. Well, this is looking at full year 2013. So the next slide is looking at Q4, and you see again this same trend of an acceleration of activity, even more so. You see a 22% increase for first sequence versus the 15% for the year. And I want to pause just for a moment to put this sequence, the financing sequences in some context, because if you think back to Claire's description of the MoneyTree report and what it's capturing, it's defined as a core measurement of VC activity. So what we're focusing on are professional investors, investors who invest somebody else's money. It does not include angel investing. So it does not include individuals who have put their own money into deals. And as we all know, anecdotally, there's a tremendous amount of activity happening at that pre-VC stage, which sits outside of these statistics that we're showing you. So this acceleration of initial funding is actually probably a lot higher in terms of number of deals because it's not taking into account angel money. Okay, sorry, that's a mouthful. So in this next slide, we're going to just look a little bit more at the first sequence financing to get a better understanding of what's going on behind that acceleration of funding. And you can see here we're looking at first sequence investments over the last 5 years divided by quarter. And you can see 2013, a very nice jump quarter over quarter in terms of money going in. The other thing that you can see here is for the past 2 or 3 years, for the most part, quarterly investments have been above the $1 billion mark, which from a MoneyTree point of view is kind of the healthy range you want it in versus below the bar. So all is good at the front end of the system in terms of money going into deals. And I think if you stand back and you think about some of the things that Claire has talked about in terms of megatrends, you can see what's pushing these first round deals. As Claire had mentioned, there's been a tremendous amount of activity in the software sector, more so than in past years. The software industry sector is comparatively a much more capital efficient sector, so it tends to drive more money, and particularly at an earlier stage. You can put money into a software company and build it to a critical mass and get to the point where you can build a company with some heft. And so it is generally one that will attract more money. I think some of the megatrends that we've seen in software, namely the consumerization of the enterprise, so people bringing their own devices to the enterprise, the rise of social media, and all the data that comes from the consumerization of the enterprise and the rise of social media and the need to deal with that. All of those industry trends, together with the fact that it's easier to build a software company compared to others, is really what's pushing this growth over the last year, and it's something that, for the most part, we think is going to continue. And about 40% of the first sequence of investments here, I should add, were in the software internet space. And this is a slide which is actually looking at the number of first sequence deals versus the dollars, which is what we looked at before, and you see a trend that that continues and reflects the dollars in. So we've looked, and I promise this is the last slide about sequence of investing. The slides we looked at before were looking just at the timing of money in without sort of tracking it back to the stage that the company is at that point. So what we did here is divide the money up by the stage of investment, so seed, early, expansion, later stage, and then overlay the first sequence dollars. And what you can see here is that seed and early stage companies garner most of the first sequence money. So that means that companies that are developing a product and may, in its early stages, have an alpha or a beta product and are in their first stages of revenue, they're the ones that are attracting that money. And for Q4, it was about 71% of total first sequence dollars. So we can advance. And again, here we're looking at the numbers of deals, and it follows a very similar pattern to the dollars in that seed and early stage companies are attracting that first sequence money. So on this slide, we're looking at the average deal slide every year, and Claire touched on this in her first overview slide. That the average deal size has actually been fairly stable over the last few years, but it's also higher than what it was pre-bubble. So it's kind of interesting, though, if you look at the past sort of 5 or 10 years, the things that have been pushing that deal size are different. If you look at sort of 5+ years back, the things that were driving that higher post-bubble average deal size were coming from the capital-intensive industries, so life science and clean tech, raising a lot of money. So there were fewer, larger deals being done in capital-intensive industries. That's kind of changed out over time as the life science, well, clean tech is just really tough. I mean, it's very difficult to raise money if you're a clean tech company. And life sciences, while there is some improvement now, that industry has been under pressure. So the larger deals now have been more in the software internet space, and they have been driven by investors putting large sums of money in companies that are very close to an exit, and that is because there's been a lot of vibrancy in the M&A and IPO market for deals in that sector.
Great, thanks, Kathleen. So speaking of which, on this slide we have the top 10 deals in the U.S. for Q4 2013. And so you can see Pinterest is at the top there in Silicon Valley at $225 million. And remember, this is out of $8.4 billion invested in Q4 2013. Second on the list is Palantir, again in Silicon Valley. MongoDB, again in Silicon Valley. You've got Juno Therapeutics, Moderna in Seattle and Boston, and then E-Recycling Group and Box, City Practice Group, and OpenPeak and Oculus. So, all big deals going from $74 million up to $225. And then going to the next slide, you'll see here the top 10 deals for the full year 2013. And again, Pinterest and Palantir are up there at the top. And you can see that 4 of the 6 deals are based in Silicon Valley, and 1 is in New York. But there still is some good investment throughout the rest of the country. You've got a large deal here in Texas, and also in Atlanta and Maryland. So there is good, I would say, vibrancy throughout the country as the economy starts to come back. And then looking at this next slide here, this is the full year 2013, looking at the most active U.S. venture investors. At the top of the list here is Kleiner Perkins at 103, First Round Capital at 94, NEA at 93, and I would say you've got like what I would call some of the usual suspects, and you'll see thrown in there are some newer VCs, and then also some corporate venture VCs as well. So good smattering across all different types of VCs. And then as Kathleen had mentioned, again, kind of at the earlier stage, even behind these VCs, you've also got angel investing and crowdfunding and a whole other host of sources of funding for these companies, especially these companies that are at the very early stages, and they're less capital intensive than in previous sectors have been. And so moving on to looking at IPO and MA activity. This is quite an interesting slide, and there's a lot of numbers on here, so just give people a moment to absorb what we're looking at here. So, we have the year there, the date, and then total M&A deals, then the average M&A deal size, number of IPOs, and then the total amount that was offered, and then the average IPO dollar amount for that year or period that's in question. So if I go to the very end of the slide, 2013, there was 377 M&A deals, an average deal size of 161. And that compares to 2012, 488 deals, an average deal size of 172. And in 2011, you had 499 at 142.6. So you can see, there was a drop in M&A activity in 2013, but still I would say, fairly healthy. And then in Q4 2013, there was 81 M&A deals compared to 116 in Q3 2013. And that compares to Q4 2012 with 126 M&A deals. So just pause for a moment so people absorb these numbers, because I know it's hard to take all these numbers in. And then moving over to number of IPOs, so going back down again to 2013, there were 82 IPOs in 2013, which was very significant compared to 2012, which had 49, which still wasn't a bad year compared to some of the earlier years. When you look at like 2008, there was only 7 IPOs, which is appalling really, and 2009 with 13 IPOs. So it started to tick back up there in 2010, and I think we're at a good, healthy number, 82 in 2013, and there still is, a strong pipeline. Q4 2013 had 24 IPOs, and Q3 2013 had 27 IPOs, and that compares to Q4 2012 with 8 IPOs. And then looking at the average deal size for IPOs on the right-hand column there, you'll see in Q4 it was quite a healthy, $221.4 million, and that compares to the previous quarter of $103 million. And then if I look at the IPO information for 2013 as a year as a whole, it was $137.2 million was the average IPO price, compared to 2012, which was $438 million. But of course, that was driven by the Facebook IPO, which you'll see there on Q2 2012, when the average IPO offer amount was, $1.4 billion. So take Facebook out of that, that kind of brings that down a bit.
So we've spent the first half of this presentation talking about where VCs put their money, and then Claire started the second half by looking at where their liquidity comes from, giving us some very interesting insights into the IPO and M&A market, the exit, which was good news. This is going to be the only sort of downer part of the presentation. So I'm now going to talk a little bit about the other way in which VCs gain access to liquidity, and that's through venture capital fundraising. And this is another busy slide, so just give you a moment to take a look at it. But basically what this slide does is it looks at VC fundraising on the top part of the slide on an annual basis, and then below looking at it more specifically quarter by quarter over the last few years. And we've divided it by first-time funds and follow-on funds. And what you can see here in terms of the overall dollars is not a pretty picture. It's been a difficult environment over the past number of years in terms of raising money. The $16.7 billion raised in 2013 represented a 15% loss decrease over 2012. And there was also not a really great trend preceding that. And if you step back and you think about recent history, what's caused this trend has been the fact that when LPs look at the VC performance over a 10-year horizon, and when the fabulous returns of the 1990s began to roll off of 10-year horizons, VC returns really suffered. For example, and it's not on the slide, but in 2010, VC 10-year returns were at a 14.3%, whereas that was in 2009, and then in 2010 they dropped from that 14.3% to a negative 4.2%. So what happened in response was that LPs either just backed out of that whole asset class completely, or they focused on the top decile performers, and so it became very difficult for funds to raise money, and that is something that has continued. And if you look at the number of funds here, what you can see is the overall number of funds, now I'm back on the chart, has dropped from 2012, but the pain has been borne by first-time funds. The number of follow-on funds has been, relatively flat, but where you see the decrease is in fundraising by first-time funds. And so what this picture shows is a picture of an industry in consolidation. So you have less money being raised overall. Most of the money is being raised by established players, and that is probably something that we're going to see continue. And Claire and I were talking about this yesterday through at least the first half of 2014. The good news is that returns, that 10-year horizon is improving. I think it was at about 8.3% as of Q3 2013. But it's going to take time for some of these IPOs and good M&A transactions to really feed through the system and continue, creating compelling stories for the VCs to raise money. Okay, so I divided the summary into good news and bad news, and I always like to get my good news first. And I have more good news than bad news, so that's good news. So, you know, overall, VC investing has continued at a very strong post-recession pace, and actually at a stronger pace than what we saw before the internet bubble. And it's been pretty stable year over year. You know, slight increase this year, but it has been at a stable point. In a recent National Venture Capital Association review, a number of VCs and CFOs were interviewed, and most of them predict that there's an expectation for higher fundraising in 2014. So we'll go with that. Software and internet right now is the place to go, although I think life sciences is going to be continuing on its improving trend given some of the exits that Claire's busy working on. And within the software internet sector, you know, we touched on some of the mega trends that are pushing a lot of the company formation and growth, and these are things that are going to continue to attract dollars, we feel, over the next year, certainly. California is definitely the place to be, and that's going to continue going forward. You know, the thing that really separates California from the other geographic areas is that, in comparison, we have such a deep ecosystem here of access to mentors, to entrepreneurs, to service providers, and to VCs. I mean, if you think about the list of the most active VCs that Claire showed us, they're all either in Massachusetts or in California, but the lion's share of them are here in California, so it's a good place to be if you're trying to start and build a company. There's the increased focus on early stage deals, which for the most part is positive. It's positive within the VC ecosystem because it primes the pump for new company formation to grow big and either go public or get acquired. There is a little bit of a dark cloud that sits outside of that, and it's what's going on in the sort of pre-VC angel funding arena. And this is not something that's touched on by MoneyTree, but we all know about it because we read about it in the press. This acceleration of early stage funding that we talked about amongst VC investors is happening at an even more rapid pace amongst angel investors, and we see it from other sources like the Halo Report or CB Insights. There is a tremendous amount of angel activity going on, and it's a bit out of balance with the VC activity that's going on. So we anticipate there are just not enough Series A and Series B outlets to take care of all of these angel-backed deals that have been done. So I do think that there could be within the angel world some contraction. There's been some irrational exuberance, and there could be some contraction in the coming years. But overall, the fact that there's early stage activity going on, it is a good thing. And then again, the exits, the IPOs, and the M&A activity should bode well for VCs, and certainly again in that recent poll done by MVCA, both investors and management of venture-backed companies believe that that is going to continue. So that's the good news. On the perhaps not so good news, some of the things to keep in mind is that the economy in 2013 didn't start out, it started out in sort of a wobbly improving note. So it was getting better, but there are still some mixed indicators both domestically and abroad, and those are still out there. I think on balance, most investors and CEOs believe that the U.S. economy will continue to grow, but it's not sort of a clear, strong direction that it goes in. And what's interesting on this poll that was done is that where you see the most positive outlook are from people who are here in the Valley and in New York and New England. While life sciences have been improving, there still is some pressure on this particular industry sector. You know, until issues with the FDA are fixed, it still is difficult to get a company to progress through the various stages it needs to, and the money there needs to be extremely patient. And so the number of VCs who are focusing on that, particularly in the early stages, is still under pressure. And needless to say, clean tech is even in a worse situation as long as the federal policies in this industry sector remain to be qualified. There's a Series A crunch, which is going to need to resolve itself more in angel land than in VC land, but still at the early stage VCs, there could be some contraction there. And last but not least, we have a funding gap. If you think about the first slide that Claire put up, more $29.4 billion was invested into companies, and if you think about the last slide that I showed, only $16.7 billion was raised by VCs. And I'm not a math whiz, but that math doesn't work over a long period of time. And so it's something that in the medium term remains kind of a cap on how much venture activity we can have. They have to move more in line with each other for real increases to occur. So these are just some summary predictions on the VC market, and I actually talked about a lot of it when I was talking about the fundraising in terms of the history behind why VC fundraising has been under pressure. So you have an industry that's in consolidation, and what is occurring now is that you have kind of a barbell structure. You have a few newer funds that are focused on specific industries or specific industries or specific regions, and then sort of much larger funds that are industry and stage agnostic. But the lion's share of money is being consolidated into a smaller number of funds. So the top performers are the ones that are attracting the most amount of money. So you have a gap between haves and have-nots, and actually in Q3, almost 60% of funds raised went to the top 5 funds. And just on a positive note, not to be a complete downer about all of this, returns, as I mentioned before, have been improving, and with the increase in the number of exits, hopefully this will feed its way through the ecosystem, and we'll see that decrease slow down and hopefully move towards some increases. And I think Claire mentioned earlier, too, another factor that's kind of weaving into this is there's a lot more corporate money that's being put into play, so that's a help. For the first time in a non-bubble year last year, corporate investors provided more than 10% of VC capital that was provided. And that's it.
Okay, thank you very much. Very interesting. We stand at about 7 minutes to the top of the hour, so we have time for a small number of questions, and as I mentioned earlier, we'll try and follow up on anything that we don't touch. Let's start with a first one. Kathleen, I'll aim this at you, but Claire, feel free to jump in.
I may duck and punt to Claire.
Okay, well, let's start with crowdfunding. Have we seen much impact from crowdfunding? Certainly there's been a lot of press on it over the last 2 years. What's going on there relative to what we see in the VC world proper?
Okay. Well, I'll try and take that one on, but Claire, feel free to chime in if you want. So when you say crowdfunding, I'm assuming what you mean is equity crowdfunding, because there are 2 different kinds. You can do crowdfunding, which is just kind of raising donations for either starting a company or disaster relief or things like that, or equity crowdfunding, which is raising money for a startup in return for equity. And I'm just going to talk about
yes,
that.
Yes, definitely the latter in relation to the conversation here with versus VC funding.
Yeah. So I would say, you know, the good thing about crowdfunding is that it sort of democratizes access to equity. So people who have an idea can go out into, you know, the populace and raise money. So it makes it a little easier to raise money. How does this affect the VC ecosystem? We really haven't seen an effect on VC investing to date. I think where it's really probably affected the greater ecosystem is in that pre-VC angel-funded area, and it may be putting some pressure on angels and being more competition for a source there. But what it also does is it kind of adds to this exuberance in the pre-VC funded area, and therefore a little bit to the Series A crunch. So yes, it does provide availability to more funding, but the investors that are behind the crowdfunding are more friends and family generally than a professional investor who may go through a different level of due diligence, and you're probably going to have to eventually go to a VC for follow-on funding. So it's unclear how those companies will progress through the ecosystem.
Got it. Great. Claire, any other comments on that topic?
You know, I mean, the only other thing I would say on crowdfunding, it'll be interesting to see how, you know, SEC rules play out, you know, in terms of crowdfunding, but I think there's more to come on that. So,
well, I think it also creates kind of a messy capital structure. Yeah. So when the VC, because you've got a lot of little investments from a lot of different people, and if VCs come in afterwards, it's not quite clear how clean the capital structure would be.
Yeah.
Got it. Great. In the MoneyTree survey, is there any indication of company stage, which is to say, you know, pre-revenue, you know, R&D, pre-revenue, revenue, size, et cetera, and any indication as to who's getting the funding?
So who in terms of stage of development?
In terms of, is it, you know, mostly revenue-generating companies, and, you know, what are the trends, or is it, you know, things have been changing in recent years in terms of companies' stage of development versus their what stage or what kind of funding they're receiving?
Right. So the answer is, and again, if you go back to the sequence of financing, that's kind of a proxy for stage. The majority of the companies that are raising money in terms of the dollars would be companies that are revenue generating. I think that's really, you know, if I think about the prospects and the clients that we have, and you think about the big rounds that Claire's, the top 10 deals, what they were looking at is that, maybe with the exception of Pinterest, because I don't know if they have any revenues, but most of them, most of the companies that raise large dollar rounds are on a pretty significant revenue ramp. So it would be revenue producing companies. So they would be expansion stage companies for later stage.
Gotcha. Okay. Now we do have a number of other questions. As I mentioned, I'll work offline with the speakers to see if we can get answers to those back to the folks asking. And in the last 2 minutes, let's go ahead and do a little bit of final housekeeping here. We would certainly like to thank PwC for the wonderful information, very well delivered today. Thanks so much, folks. We really appreciate the time from both Claire and Kathleen.
You're welcome. Thank
you.
You bet. As I mentioned during the event, we will have a short survey. Once I shut this down, immediately a short survey will come up. We appreciate you taking the extra 60 seconds and giving us the feedback. We'd like to do future events with PwC along these lines. We'd like to make sure we're bringing the information and presenting it the way that the audience would like it. So please give us your feedback. And also, please join us at performative.com if you want to continue the conversation, where we're always going back and forth among things that are important to the Office of the CFO, and fundraising is certainly one of those. So with that, we will thank everyone for taking time out of your busy day to join us. It is 1 minute before the top of the hour, so hopefully that gives you the 1 minute to take those final survey questions. We hope to see you again soon at another Performative webinar or at Performative Online. And one final thanks to our friends at PwC. Take care. Have a great week, everyone.